Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to cover our normal, the overview, the deep dive into U.S. refined products, and then going abroad. Now, as we said last week, the demand side to the refined products kind of overshot to the downside. Again, that was that residual to Colonial, those movements that were happening, and now we've had that go an overshoot to the upside a bit, and we're going to start to balance out where we had that spike, the decline, the spike again, and now we're going to start to get into some normalcy, if you will, on the product side. And then we're going to look at more specifically, what are some days of supply? What is the normal levels that we're seeing right now? Because right now we had a fairly bullish crude number in terms of the draws, a little bit of a bearish gasoline number, and then distillate is the one that we really have that spare capacity to bring in these additional imports. And the one thing that we're starting to see as we go forward, just given the strength and spreads really, is that you're going to see some pressure come into U.S. exports. Now, we did get some nice exports going into Europe. That will continue for the next couple, let's say the next 2 weeks, and then you're going to start to see that slow down, just given some of the spreads that we've seen. Here, we're just going to go through some of the specifics when we start looking at days supplied and what does it mean going forward. So when we look at DOE days of supply for crude oil specifically, so here's where you can see that we're just crossing over where we were in 2016. That top number was where we were obviously for 2020. And you can see kind of where we sit right now, that we're still at a very elevated level from days of crude supply. But it's starting to normalize a bit closer to kind of that last time we had this big spike higher. So again, there's been a lot of front running with crude prices ahead of this move. It's a mixture of inflation, the expectations of growth, and that's where we've seen this kind of steady decline. And now you can see that the rate of change has started to pick up a bit. But the one thing that we remain concerned on, and it's the things that we're seeing, is just this headwind in terms of new exports and those additional imports. Because when you look at refiners right now, as they continue to increase run rates, they're going to have to get that slate heavier, and you're going to start to see that show up in the distillate side. Now, a gentleman on Twitter was kind enough to put the days supplied on just a scatter chart. And I thought this was really interesting to see, where we're seeing things right now. So when you look at the scatter chart, the U.S. crude 4-week average days of supply is at about 31 days. And here you can see kind of where the normal price distribution is in terms of where things sit against those days of supply. So right now we're between 30 and 31. And you can see just kind of where we sit in general. And on the bullish side, you're going to say, okay, well, people are expecting more. We've seen a pretty steady draw. This is why people are kind of getting in front of that. And then on the bearish side, it's like, okay, a lot of this is inflation baked in. We're going to have to see the Fed is going to speak in about an hour or so. So this is just inflation moving ahead. And it's a mixture of both, and that's why there's some of that demand side. Where obviously things are getting better here. There's still some headwinds abroad, which we'll talk about in segment 3. But there's also that inflation baked in. There's a lot of that growth baked in. So it's just going to be a matter of kind of getting to some of that balance. Now we have to continue to see these crude draws in order to kind of continue to see this pull down and to see the supply, the days of supply continue to move further down, really to support kind of where we sit on a price level. Because typically where we sit right now, it's closer to 24, 25 days. So these are going to be things to watch over the coming few weeks. Now, when we look at total U.S. commercial oil storage and products, so this is looking at everything. What is in the U.S. right now? And this is where we like to layer in. Now, we don't include propane. This is just looking at our typical backdrop of oil, gasoline, disti, jet fuel, and resid. And here you can see that we've had a fairly flattish move, and we haven't seen too much of a decline in any meaningful way. it's been it's been steady. I'm not saying that it hasn't been coming down, because it has been, but it's just we haven't been seeing this big rate of change, only because when you look at, there have been times where we've been having really big crude builds, but then really big product draws, and then we've seen that flip, and we haven't seen a very steady movement in terms of some of these declines. Like when you look at last week, we had that kind of that shift up. Now we're taking some of that back, but we haven't really seen a very steady move lower, which is something that we want to see change. And one of the reasons why, so when we look at gasoline over the last 29 years, this is the second highest we've ever been, outside of obviously 2020. So here you can see kind of where we sit on the gasoline side. Then when we look at distillate is a bit more normal, if you will, and much closer to what we were in about 2015. And it's interesting because this is typically where we start to see builds. So it's not going to be unheard of to start to see distillate builds, because you're preparing for winter. You need to increase gasoline production, so you're going to increase, inherently you're going to increase distillate production. But as gasoline continues to work higher, the question is going to be, how much can you expand? Are we going to start to see some of the slowdown in refinery utilization rates? Short answer to me is going to be no, because there is spare capacity. There is enough capacity for gasoline, and U.S. exports for gasoline have remained fairly strong, and we don't really see that changing in the near term, so that'll provide some outlet to help kind of balance that market. Then when we look at jet fuel, so jet fuel is at the highest it's been outside of, again, 2020. When we look at just how quickly jet fuel has really come back, and when you look at the distillate draw, it's also you can also say, okay, well, they're also recovering more jet or kerosene, and that can get dumped directly into the distillate pool. So as that gets recovered more, that's where we're starting to see these builds. Now, it's anecdotal, and we have the data on it, but just to think about this in another way, I flew down to Florida last week, as I told everyone, and when, me being the obnoxious person that I am, I was just talking to, we were delayed, and I was talking to the individuals working the desk, and I was like, how have the flights been? They're like, oh, the flights have been packed. And I was like, okay, well, flights have been packed. How many flights do you normally have on this route? And they were like, well, we average about 9. And I was like, okay, well, how many do you have right now? And they're like, all right, we have 5. So, and the woman that I was talking to, she has been doing this for 30 years. And I said, what would be your expectation? She's like, based on how consistent things have been, we would expect another 2 flights to be added, fairly quickly, given where things are. But they haven't heard that they're going to add any of these flights, because they're trying to maximize their occupancy rates and just the amount of people on these flights, because they're trying to make back some of that money. And that's where we're going to start to see some of those pushback, where passengers have continued to go up, but we haven't seen departures really start to pick back up. And that's where we're going to see some of that bifurcation of where are our passengers and where are new departures. And that's why we always look at both to understand where we sit in that cycle. And that's where we continue to see this buildup in jet fuel. So then when we look at the curve, we had to add another pretty little line, because we're pretty close to 6, we're holding above 65 here. So we're above 65 through August of next year. Obviously this provides opportunity for any type of hedging or something. And when we say hedging, there's a lot of ways to do it. But just given where volatility is, where things are, puts still remain a very good option, where you buy just some insurance, where if it comes down, you're protected. If it continues to go up, you have complete upside. So there's something to be said about that. Or if you think it's going to be capped in this range, this is where you can have collars, you can have get a bit more creative, put spreads, if you will. So here's where we can kind of see where things sit. And then as you go into 60, that's well into 2023. And then above 55, we're already into 2026. And not to say that matters in any really meaningful way, just because the curve isn't really predictive. But it just provides a certain amount of support for new investment, going offshore, what are some of the purchases? And that's where, now I say that, but how many of these companies are going to be allowed under their green push and whatnot to have this capacity? But again, the curve is supporting some longer term investments. So then when we look at COVID net changes, things continue to move in the right direction on a worldwide level, on the US level, Europe as well. France is going to come out of their curfew. Japan is going to come out of their state of emergency as of June 20th. So we're starting to see some of that additional normalcy rolling through. The UK has started to go up a small amount, and whether you want to call it the Indian variant or the Delta variant, you do you. But when we look at where things are right now, we're starting to see some of that slowdown. And there's some individuals that when you look at what's happening in Asia, you're seeing India coming down, and that's pulling down Asia Pacific. But that variant is showing up and remains active in South Korea. You can see it in Malaysia, Vietnam. So those are some of those headwinds, if you will, to some of that normalcy in the Asian side. But we'll talk about that more in segment 3. But so far, when you look at the US and Europe in general, things continue to move in a positive direction thinking about COVID. And we'll talk about vaccine rates, percentage of vaccinated in segment 2, because obviously that's going to be imperative for not having that next wave. And we've already seen the success in really not having that next wave. Even when you look at the UK, even though this variant has become more pronounced, we're just not seeing A, the same type of spread, B, the same type of people going to the hospital, and so the vaccines are proving very effective, which is obviously the net positive. So now when we look, we have a fairly big draw, and we always look at obviously both sides. So when we look at the total on commercial side, it was 7.36 million. When we look at the SPR, it was 8.25 million draw. So when we look against the 5-year average, that takes us 33.5 million below the 5-year average. And when we look at what is driving that, it is again sitting with pad 1, pad 2, and pad 5, where pad 3 is starting to come into that balancing component, which has been kind of that bigger driver on the way down. Now, Cushing had a draw of 2.15 million, going 8.6 below the 5-year average. But when we look at it against the last 15 years, things are moving fairly in the right direction in general. The bigger issue coming up is going to be what are exports going to do, and then this production. So you can see that they took their estimates higher to 11.2 million. This is something where right now we're estimating that we're already at about 11 point, a little bit above this, like closer to 11.3, on our way up to about 11.5 as we progress through the middle of summer. So this is going to be something to watch to see, okay, well, where are imports? Because imports increased, but exports had that nice push out. So that's going to be something to look for as we go forward. Then looking at storage in general, total land storage around the world is coming closer to that 5-year average. West of Suez is now really just below the 5-year. It's the east of Suez when we look into Asia that we continue to track closer to that 2020 level. And that's where we continue to see some of this overhang when we talk about Asia and where some of those flows are really coming from, because that's where we're seeing some of this overhang. So stockpiles fell by 3 million to 651.6 million. Now, mind you, this doesn't include this week's numbers. So we're just looking at the aggregate in general. Then we'll update it as we go through the show, which is a fall after having that drop from 6.4 million. So again, that positive move on west of Suez, but we're still waiting to see that come through on east of Suez. And we saw Fujairah had a big increase in storage. And we continue to see some of that elevated levels within Asia. But again, we'll talk about that segment 3. Then when we look at floating storage, things are moving in a fairly steady level. We're right at the 2016 levels, which is where, as we know, that there was a big drop off in the OPEC deal, Thanksgiving of 2014. And then you had those steady increases. So we're just back at those levels. So still elevated, but working their way back down. And it remains to be, the east of Suez continues to be the biggest overhang. West of Suez, U.S. Gulf fairly flat. Europe, has come down, but West Africa has had a fairly large increase. But we'll talk about that more in segment 3 as well. Now, when we look at fuel recovery, China has slowed down. They've stopped reporting things because they're China, and that's what they like to do when things don't go the way they want them to. It's still not. I mean, it's not back to the 80%, but it remains at that. It's 90 to 95% of normal. Europe continues to trend higher as the rest of Asia is slowing down, driven by some of the issues that we've seen in just terms of the lockdowns, some of those issues in that Delta variant going through. And then when we look at the Americas are continuing to recover a bit, really driven based on how quickly Latin America is going to come back, which they're starting to come out of their COVID slowdown. So when we look at commercial, excluding SPR, we're getting close to that February low, again, coming back down closer to that normal. But that's why we always look at that 29 years, just because where have we been normally? Where do we sit going forward? And you can see that the rate of change has accelerated, and the 29-year average typically draws at this point in time, but you can see that the rate of change has accelerated, which again is a net positive for where we sit right now. The problem is going to be going forward in terms of that import-export side, because as we've said time and time again on this show, the Frac Spread Show, that we do see production increasing, again, not getting to 12 million, but still on a steady pace higher. And it's going to be a matter of where are refiner assets, and then how much of those imports start to come to our coast. And that's when you look at Pad 3. So Pad 3 is still above that low point that was reached prior to the freeze-off. Then obviously you had that big spike. But this is where we've seen a bit of a slowdown, and we typically draw at this point in time. It's just, again, speaking to where are imports, where are exports, and this is going to be that important driver just because this is where most or a large part of our U.S. storage resides. So then when we look at Cushing, as we were saying before, we had been going fairly flat. Now we had a little bit of a makeup draw, which is a net positive in general in terms of where we sit. But when you look at that 15-year average, we typically have that drawdown over this time period. It's just based on that shift between where are we with exports, where are we with production. We still remain the case that we think that we're going to be fairly flattish going forward on an average level as we go through the remainder of June. Then when we look at imports, so imports increased by 107,000 barrels a day to 6.745 million. It's still 825,000 below the 5-year average, but two of the places that we said that we expected to see some of those increases were really Pad 3, Pad 5. And Pad 5, we had a fairly big increase, 220,000 barrels a day, which is 200 above that 5-year average. And that's what we continue to see, where the Pad 5 is picking up some of that excess Pacific crude, and you're going to see Pad 3 continuing to ramp back up because they have to bring in that excess crude in order to run the refiners at the rate they need to be run at, given that they have to be a heavier cut of API. Then when we look at Pad 2, as we were saying, we were going to get that kind of correction down after that big spike. We had it. It was down 416,000 barrels a day, still slightly above the 5-year average, but again, we're continuing to see that. But then when we talk about Pad 5 again, the June loading shipments of clean fuels. So now we're going to talk about refined products from Asia to the Americas rose to 200,000 tons from 95 tons a week earlier. And that's where we continue to see this lumpy shift where it gets pulled through, then we see it drop, and then we get another surge coming. And this is going to be a continuous cycle that we believe is going to continue to come in. And when we look at what has happened, so 35,000 tons of diesel to Brazil from Sakha, India, which is the first shipment that has come to Brazil from Asia since November of 2019, just to kind of give you an idea of just how much Asian product there is and how it's going to continue to come into the Atlantic Basin, into LATAM, into the U.S. and in Europe. And now we have another 2 tankers coming from South Korea into the West Coast. So again, these are things to consider when we're looking at how are runs going to go, how are they going to try to kind of manage some of those different levels. Then when we look at crude oil runs, this is one that took us by surprise a bit. We thought it was going to be a little bit lower. Here we are up 1.3%, 92.6% in total. Pad 2 is on fire, at 97% operation. Pad 3, which was the one that we expected to see the biggest increase in activity, we had the increase of 197,000 barrels a day. The Pad 2 is the one that, based on how hot they're running right now, they're going to have to increase those imports from Canada, which is something that we're going to continue to see, and again, be that offset to where some of the flows are. But just given where we are, we're now very close to that seasonal norm, and just given where oil is, where refined products are, the space and distillate, we don't see these refiners cutting really in the near term, just given where they see exports right now and U.S. flow. So then when we look to the implied demand side, so here's that kind of that skip back up after what we were saying before, where gasoline was up 880,000 barrels a day to 9.36. This is where we think that you had that spike. Now you're going to pull back a little bit. Again, not a huge pullback at all. I'm not saying that. It's just it's going to normalize now. Distillate is going to have the biggest normalization next week. There was a big surge of 923,000 barrels a day, bringing us to 4.3. That's a huge shift higher. That's one that's going to normalize. Jet fuel had an increase of 226,000. That's going to be kind of well within that confidence range of that 1.1, 1.3. Distillate was the one that really broke above where we thought it was going to stay. But again, it all comes down to where is the flow going, who's buying it, where were some of the shortfalls, and those are going to be things to continue to see. And then U.S. Gasoline imports from Europe are in the 6 days through June 9th were relatively unchanged from the prior week, again, staying elevated. Rivals were up slightly to 280,000 barrels a day between June 4th to 9th, which, just to give you an idea of where we sit right now, which compares to 278,000 barrels. We're continuing to see this pretty steady increase, especially coming over from Europe. When we look at floating storage, again, this is that timing delay. This is one that we think is going to continue to trend up based on where purchases are, where the U.S. is trying to pull in new barrels. And the reason why we say that is because, as we were saying before, we believed imports were going to break to new 2021 highs and come back within the bottom of that cloud. And, here we are. So you're going to have to get some of that buffer, especially if we're going to have Pad 3 refiners operating at current levels and starting to trend higher. They're going to need more of that heavy crude. So again, going to be that steady increase that's going to come through. And then here's that kind of lumpiness that we were talking about with Pad 2. You had the big spike, the drop back. We still think it's going to remain, especially at current operation, refined utilization rates. You're going to stay really in that top of the cloud as we go through the next few weeks. And here's where we look at refinery utilization rates over the last 29 years, again, coming right back into where we should be right now. And this is where, typically you start to see some of that balancing out, but it'll still be a pretty steady trend as we get into July 4th weekend, because that is really the peak of driving season, which is expected to be fairly strong. So those are the things that we're seeing right now. That's kind of the overview. Now, as we go into segment 2, we're going to do a deeper dive into just the U.S., and then we're going to break off in segment 3 and do a deeper dive into just the global backdrop, with some updates on where kind of that physical market is, where some of the demand levels, where's global storage. So to give you some of that color to help you understand where the market is today.